Welcome to Real Estate Economics Weekly Webinar Series. Real Estate Economics is a leading provider of residential market consulting and online research tools. Every week we post to the internet a webinar covering a variety of topics. This week we'll be addressing San Luis Obispo County, California. I'm John Mulville. The upcoming schedule looks like this. On September 29th, we'll begin the Southern California area, first with Los Angeles County. 1 week later, on Wednesday, October 6th, Mark Bad will be presenting Orange County. 1 week later, the Inland Empire, following on October 20th at 9 a.m. with Kern County. At any time, you can check our webinar schedule at www.realestateeconomics.com. For sponsorship opportunities or sales information, please contact Judy Duell at judyduell@realestateeconomics.com. In our review of San Luis Obispo County, we'd like to take a look back to years 2006 through the present and look at the conditions on the ground and compare those to the current conditions and forecasts in part 2 of today's two-part series. This particular exhibit comes from our housing transaction report and covers the single month July 2006. We'd like to put the historical perspective in order here. In this map, the blue dots are conventional owner-to-owner resales. The green dots are new home or builder subdivision sales. The burnt orange are foreclosures, that's owner back to lender, and the yellow are foreclosure sales, that's lender out to new third-party owner. You can see as of 2006 the economy was performing fairly well, mortgage money was available, and resale activity and new builder sales really dominated the market. Conventional sales ran almost 82% of the total volume. New builder sales, a healthy figure at 14.8%, and foreclosure sales were very small part of the market at this point in time. Let's come forward a full year to July 2007. Conventional resales, shown in blue, 75% at this point in time. New builder sales still remaining strong at about 14.2%. You can see the initial signs of distress here. Interestingly, it opens up or first manifests itself in a Atascadero with the congregation of yellow and burnt orange dots in this particular map, and now foreclosures are up to about 5%, foreclosure sales about 5%, so distressed running about 10.4% of the total sales volume. Still many of the coastal markets are performing well. The light green dots are showing new builder transactions in a couple of markets. This is an area, for those of you who aren't that familiar with it, this particular map would run about 60 miles from north to south, so the geography is fairly large. Santa Barbara counties to the south and Monterey counties to the north. Let's come forward one more year to July 2008. At this point in time, we're starting to see some difficulties with subprime resets, people's payments increasing very quickly, early signs of economic shock, and some early indications that we're having credit strains in the financial system. At this point in time, conventional resales, owner-to-owner transactions have come to under 60% of the total volume. New builder sales have come off all the way to 6.7%. Foreclosures are now 20.8%, and foreclosure sales 12.8%. As you can see, Atascadero seems to lead the distressed inventory creation here. Paso Robles is starting to pick up in some of the outlying areas, some of which are rural, resort, second home markets are beginning to show the early signs of distress. At the end of 2008, it became no longer possible to deduct your interest on your second home. So at this point in time, this area, which typically enjoys very good mature buyer market, second home demand, that sort of thing, is starting to see weakness in non-primary, first house demand. Let's come forward to July 2009. At this point in time, resale volume 61.9%. New builder sales have dropped all the way to 3.4%. Foreclosures are now 15.9% and foreclosure sales 18.8%. At this point, you can see that the distress has really carried down into the south part of the county. Nipomo, Grover Beach, Arroyo Grandes, you can see yellow and orange dots in both those markets. Atascadero still seems to be a little bit farther on the curve here, with a few more foreclosures and foreclosure sales, and also Paso Robles seeing some too. Outlying markets still have a scattering of foreclosures and foreclosure sales. Let's come forward one more year, July 2010. This is the current information. As you can see, the owner-to-owner resale transactions are starting to pick up a little bit here. This is something we're seeing throughout the region. Lenders are preferring to agree to short sales as opposed to repossessing a house and marketing it on their own. We've been not surprised, but maybe pleasantly encouraged that many occupants of a short sale will mow the lawn and flush the toilet and keep the place from really going downhill, compared to a repossessed home that tends to suffer a lot of depreciation, if not outright damage. At this point in time, new builder activity's fallen near zero to just 3 sales during this particular month. Foreclosures 18.3% and foreclosure sales 18%. So those two categories, foreclosures and foreclosure sales, are running about equal, at least on this particular month. So we would have no real accumulated buildup of shadow inventory on this month alone in this particular market area. Let's look at housing price trends over this 5-year period, shown from July 2006 to July 2010, the same time period covered in our just presented map series. In July 2006, average prices in this market were over $600,000, with value ratios about $414 per square foot. The average home in this county has tended to be fairly small, in the 1,300, maybe 1,400 or 1,500 foot range. Historically, the housing stock does not grow very quickly, so the inventory tends to be a little bit older. Small houses, generally good lots, good lot sizes, so the house sizes are really not consuming all the lots. You can see over the 5 years in this particular series, we've suffered tremendous price degradation, 414 down to 238. Something interesting comes up in July 2010 here. We had quite an increase in the average home size. As I just mentioned, 1,300 or 1,400 feet had been the historical norm over quite some time. In 2010, this last monthly series, we've seen an increase to about 1,700 square feet in this data. This could be one of the first signs of new investment in this area in terms of people that are interested in this market going up there and really picking up a slightly larger home that fits their needs, that might have been priced beyond their means in previous years. Here's the single-family residence versus condo sales volume. As you can see, over a 5-year period, the SFR volume is really pretty consistent, with a range of only 300 to 363. Condo volume has tended to decline as the second home market hasn't produced quite as many people. This is a good market for mature buyers in higher income levels, so it's not that the condo market is eternally frustrated here. It's just that single-family homes present really much greater livability, and now that the affordability has come way down, most buyers are going to go for the lower density alternative. Let's look at the distribution of sales by price range. This is very interesting. This is on a 3-year basis. The 5-year chart for this gets a little busy, so I've kept this to just 3 years at this particular time. 2 years ago is yellow. 1 year ago is the pinkish, and purple is the current period. You can see the 500 to 600 and 600 to 800 had tremendous demand, even as frequently or as recently as 2 years ago, as this market pulled a lot of discretionary retired buyers, mature buyers, pre-retirement into this market. That all evaporated a year ago, with the 200 to 300 and 300 to 400 taking over most of the volume. Now, an interesting thing is happening here, and is happening in a lot of markets regionally. Look at the 600 to 800 price range. We've seen an uptick in volume there. There are many, many markets that people have been priced out of for years and years, that as they come back to very affordable levels, there's latent demand that's just been sitting on the sidelines waiting for lower prices. We've seen this in many of the beach communities around the country. Aspen, Newport Beach, and some of the really sort of high demand coastal areas have pulled in, and non-coastal areas have pulled in a lot of people who, if they've got the means and if their job situation is secure, they have accumulated equity, are making purchases in these premier and trophy property markets. That's the end of part one today. We're presenting a two-part series, so please join us for part two.